So you want to make an offer on an apartment. What happens next? Well, obviously you've done your due diligence, you've spoken to your lawyer, you've got advice, you've spoken to your broker or your bank, and you've got your finance organised. The next thing is dealing with a sale and purchase agreement, which can be quite scary. I mean, you're dealing in numbers that are very large, and you're coming across a piece of paper or a document that you don't see very often. So what I'm going to do is go through the first page of a sale and purchase agreement today, and in the next podcast I'll go through the rest of the agreement. So it means when you come to making that offer, you feel comfortable and you know what you're dealing with. Okay, so the first thing we see here is obviously agreement for sale and purchase of real estate. Now this is standard for any piece of land throughout New Zealand, and now obviously I'm going to be talking about putting an offer on an apartment. The first thing you hear here is date, and that's probably the first mistake people do. They think of putting a date on it. Now the date is the last thing, I'm putting an L there, that you put on the agreement. It's once the date is put on the agreement once both parties, i.e. the vendor and the purchaser, have both agreed on terms, price, settlement dates, all that kind of thing, and then the date is put on. So it's basically the last person who touches the agreement or writes on the agreement. And the reason why that is because if you have a condition like finance, which is 5 working days, it has to be from a particular date. And if your negotiation takes a couple of days, well, that's always changing. So that's the last thing. Obviously vendor, now that's going to be the vendor's name or what instrument, i.e. company or trust, the property or the apartment is under. Then you're going to have purchaser. Now purchaser, this is going to be your name, okay? Because you can't put a trust in there. There has to be someone accountable when you're actually going into sale and purchase agreement. Now, but remember, you've got this annual nominee here. So you think, I want to purchase underneath my trust. Well, what happens is you purchase it, and then when you're going through what's called the conveyance of the property, or this is what a lawyer will look after for you, they'll change it and put it underneath the trust for when you settle it, or under the company, or even nominate it to someone else. Okay, for example, I could purchase a property underneath Andrew Murray and give it to nominate my sister, and so I'm buying it for her, but I'm not just doing the sale and purchase agreement for her. Okay, anyway, then you've got the vendor is registered under the GST Act in respect of the transaction evidenced by this agreement and or will be registered at settlement. Now, if this is a yes, you definitely want to be getting your accountant's approval on this agreement. Not because a real estate agent can't explain to you, but GST gets very, very complicated. It means you're dealing with somebody who either has GST owing on the property and is registered, or a hotel lease, or there's something to do with the property where there's some commercial activity. And that can get very confusing. And yes, you can have a real estate agent explain it to you, but I've seen a lot of real estate agents get this wrong. So you want to make sure that if that's a yes, you're also seeking advice from or approval from your accountant, which you can put in conditions later, which I'll explain in other podcasts. Okay, next is your property address. So obviously that is if you're buying, say for example, 4D, 71 Northern Street and Regency Apartments, that address will be in here. Okay, the next is obviously the type it is. And now we're buying an apartment here, which means it's strata. Okay, and it's either going to be a freehold apartment or a leasehold apartment. So it's either going to be circling one of these. Okay, that's why these ones are crossed out, because obviously I specialise in apartments, so we're not dealing with this. Now there are some objections to the rule. That's when you have an OPEX. There's only a few buildings in the city, and an agent will make you aware of that. And that's when an apartment doesn't fall under the Unit Titles Act. But that's a little bit complicated. You don't really need to know that at the moment. Anyway, the next one is area. So this area, you will never have an area of, say you've got an area of an apartment, how big it is. That won't be here, because what you're dealing with when you're selling an apartment is the area we're talking about land here, okay? And your apartment is actually kind of in the sky in a way, so you're never going to have land. The land is owned by all the apartment owners collectively, and that's called a body corporate. Anyway, then you're going to have basically the what's called the legal description, which is, it'll be a unit number and a DP number, and it'll be a lot of numbers. It may not mean much. It'll have things like AU, which means accessory unit, if it has storage space or a car park, and then your unique identifier or certificate of title. That's the number which is basically on the title, which is if you've seen the title before, it'll have a number which is applied to every single piece of land in New Zealand, has its own unique number. So that means it can be found on what's called LINZ, the Land Information of New Zealand, and so it can be searched. Okay, so that number will be in there as well. Next, you're coming to the all-important purchase price. Now, no doubt you have a listing price, it could be by auction, but basically that's the price you're going to be buying it from. You may be negotiating, you may be putting, say, excuse my, I suppose it's not handwriting, mouse writing, $300,000, and it's, you know, the apartment may be listed at $320, you're trying to get it for less, and then, for example, the vendor will cross it out and will initial it, and then put in another price. Okay, so that part's probably quite obvious. Now here is another important part, you've got the GST element. So here you've got C plus GST is crossed out, should always be inclusive of GST. That means the purchase price you're paying doesn't involve any goods and services tax over it. If it is inclusive of GST, it's the same with this Y at the top here. Make sure in the conditions you have this is approved by your accountant, because it means this transaction will have involved some commercial activity at some stage and may have some GST owing on it. So you want to make sure that what you're buying into, you're very, very aware. Having said that, the real estate agent should explain that to you, but still make sure you get an accountant's advice, because GST can be very confusing. Anyway, then you come down to deposit clause. A lot of people ask me, well, how much deposit should you put? Really, I mean, a safe number is sort of 10% of purchase price or less. At the end of the day, there is no rules when it comes to deposit, but you've got to show the purchaser that you're serious. So you put $1,000, that doesn't mean much. You can walk away from $1,000. So, you know, having a reasonable amount. And then what's going to be happening here, I mean, that's our stuff here, but basically it's going to be, you have a deposit and it'll be saying to be deposited into trust account. Generally that'll be the real estate agent's trust account, and it'll generally then say, you want it to say then to be deposited not on the date of this agreement, because you may have conditions, but when it goes, this is important, unconditional, excuse my mouse writing again. Okay, so the payment of the deposit is due upon this date going unconditional, not just the date. Okay, then you've got your settlement date. That'll be the date that you want to settle their property. Let's say you're buying it and you do, but you want to be moving in 2 months' time. So let's say it's February the 19th. You've got February the 19th, 2015, or whatever. And you've got here or earlier by mutual agreement. That's something we just put in. It's nice to put that in, it gives you flexibility to be able to, you know, negotiate with your party. And here you can see here, which is just missed out, is in the manner described in further terms of sale. Now that's very, very, very rarely ever apply, but if that's the case, that means the balance of the purchase will be done in a different way or form, and it's something that is very specialised and you don't come across very often. Then you'll have interest rate for late settlement. That's generally blank, but we have a standard. It's generally about 14%, could be 16, 12, or 18. So that means the person, if you're purchasing the unit and the owner can't settle for a reason, maybe they can't get the tenant out or anything like that, that means you'll make 14% of the overall purchase price of that price a year divided by 365 or 364 if it's leap year. So there's a penalty, because otherwise, you know, you want the person you're purchasing it off, the vendor, to be settling on that date. And so there has to be a penalty involved if they can't. And the same applies for you if you're purchasing. Now I'm going to go to the second page. Okay, so here you can see, now this is the second, well, not the second page, the second half of the first page. So I've already done the purchase price, which I went over, and obviously the settlement date, which is here, and just the last thing I talked about was interest for late settlement. Now we're going to talk about your conditions. So this is your finance condition. So for example, this is if you're going to have a finance condition, obviously purchasing with cash with unconditionally is very powerful, but you have a finance condition where you may have, it's from a first tier lender. That means you can go to any major bank. That's the good thing, rather than saying one bank or just finance. So first tier, I might stop writing because I'm not that good at it. And then you have the amount required, so it could be 80%, 60%. In the finance date, generally you'll put in working days, so maybe 5 working days from the date of this agreement. So always see referring back to that date from the start. It could be 10 working days, 7 working days. Most common is 5 to 7. 10 can be a bit long. LIM required. Okay, you want to do a LIM report on the. So you put a yes here. Building report required. Okay, if you want that, yes there, etc., etc. And it depends on what kind of due diligence you want to do there. Then you have tenancies. Okay, so that depends on if it's, you may want it vacant because you're moving in. right? So you put vacant here. If it's an investment and you want the tenants are paying a good rent, you want to keep the tenants, and the good tenants you'll say current tenancy, as per current tenancy. Okay, and the rest here is just basically office stuff. Okay, so by the real estate agent. So that goes over the first page, bit of a long one. Now, in each next podcast, I will go over, the whole sale and purchase agreement. So spend a bit of time with me, it's worth it. So when it comes in front of you, you feel more comfortable because it's a big deal and it's important. And I hope that helps, and talk soon. Cheers.